How does the stock market do during war times? That's what we're going to talk about in this video. You would think the stock market would be pretty rough during these times because we all know that uncertainty is not good for stock prices. Market is a lot less volatile and gives you better returns when there's not random things popping off. Because markets are based off expectations, so people aren't able to set their expectations unless things are, kind of going smooth. So based off that and the fact that wartime is completely unpredictable because wars are unpredictable, you would think the stock market would have a tough time. So let's look at the stats. But before we get into that, if you haven't already, make sure you download our free FOMO trading guide. Helps you deal with all your emotions. There's a link to this down below in the description and comments. But all right, let's take a look at World War I. And this is an article from Fortune that put together all these stats. So following the onset of World War I in 1914, the Dow fell more than 30%. Business basically stopped and market liquidity dried up. And they actually closed the stock market that year, which is crazy to think about now. So that lasted for a whole 6 months. But in 1915, after the stock market reopened, it rose 88%. It shot up, which is still the highest annual return on record for the Dow Jones. And this was still during the war. The war is still going on. So from the start of the war in 1914 until it ended in late 1918, the Dow went up more than 43% total, or almost 9% annually. So it did pretty well even during the horrible World War I. And I forgot to mention, the reason we're talking about this is because everyone's talking about World War III, which, as I explained in the last video, isn't about to happen. So if you want to learn more about that, check it out. But regardless, it's still interesting to see how the market does during an actual wartime. World War II also worked out pretty well for stocks. Hitler invaded Poland on September 1st, 1939. And when the market opened on September 5th, the Dow shot up almost 10% higher that day. That was on the news that Hitler invaded. That's crazy. Then when Pearl Harbor happened in December 1941, stocks opened up the following Monday down almost 3%. Pretty bad, but it only took a month to regain those losses. On D-Day in 1944, the stock market barely even moved, and then the Dow rose more than 5% over that month. So during World War II, which was between 1939 and 1945, the Dow was up a total of 50%, more than 7% a year. So during the two worst wars in modern history, the stock market was up a combined 115%. So if anything, it looks like war is actually good for the stock market. And that's kind of what we were talking about in the last video, where Alex explained that with war news, you pretty much fade the news. So if the market takes a dip on missiles launching, you generally want to buy that dip. The Korean War was between 1950 and 1953, and the Dow was up 16% annually, or almost 60% in total. The year Vietnam started in 65, the market was up 10%. By the time Vietnam was over in 1973, the market was up a total of 43%, so just under 5% a year. Cuban Missile Crisis lasted 13 days, and in that 2-week period, the Dow just lost 1.2%. Didn't crash or anything like that. And then for the remainder of the year, the Dow rose 10%. So veteran trader Art Cashin tells a story about the advice he received during the Cuban Missile Crisis, because he obviously was worried about the stock market. But Jack said to him, which I guess was his mentor, "Look, kid, if you hear the missiles are flying, you buy them. You don't sell them." Art was like, "What? You buy them?" And he's like, "Sure, you buy them, because if you're wrong, the trade will never clear. We'll all be dead." That's one way to look at it. Now, September 11th, that was a pretty bad market drop. Stocks fell almost 15% in less than 2 weeks following. But you got to consider that the economy was already in the middle of a recession at that point, and stocks were still dropping from that dot-com bubble bursting. But once again, within a few months, the stock market made back all the losses that occurred after 9/11. So it's once again about fading that war move. If things drop, it might be actually a buying opportunity. US invaded Iraq in 2003 and stocks rose 2.3% the following day. And the market finished up more than 30% that year. But you got to see that these gains were coming off the brutal 2000 to 2002 bear market. So in the last video, what Alex from MacroOps was saying, that more than any of this war news, what affects the stock market is technical, sentiment, and fundamentals. So how are companies' earnings coming in? What's the trend? How's liquidity looking? That's more important than the actual war. And based off these stats, you can see that most of the time a war is actually good for the stock market. So if you're spooked by all this Iran nonsense, well, don't be. And if you're having trouble with your emotions, make sure you download this free guide. It has a bunch of tips and tricks to help you control them. There's a link down below in the description and comments where you can just throw in your name and email and I'll send it to you for free. So definitely do that. And if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get email notifications of all our new videos. We publish a lot of them and you don't want to miss them. So subscribe and I'll see you in the next one. Stay fallible out there. Bye.